Welcome to this explainer. Today, we are absolutely untangling the wildly complex web of Indian tax laws and cross-border regulations. We're going to do this by looking at a massive, very high-stakes scenario. We are tracking exactly how big money moves across borders and uncovering those hidden traps that literally catch thousands of families completely off guard every single year. So let's jump right into a huge, incredibly common question that so many families face. Can an NRI send a whopping 1 crore rupees to their parents back in India? I mean, it seems simple enough, right? Just imagine someone working abroad, wanting to support their family back home, maybe help them buy a nice property, or just secure their retirement. Now, a lot of folks just assume the answer is a straightforward yes, it's your money. But hold on, because there are some really critical tax and FEMA rules you need to understand first. India doesn't actually have a separate standalone gift tax today, but don't let that fool you. Gifts are still heavily governed by provisions of the Income Tax Act and FEMA. If you're gifting money to specified relatives, it's generally not taxable for them under Indian law. However, gifts to non-relatives, property transfers, or the income generated from those gifted assets, those can trigger vastly different tax consequences. The bottom line is you can't just wire a massive sum and assume you're in the clear. Let's peel back that very first layer, taxes. We have to talk about Section 56(2)(x) of the Income Tax Act, which is basically the cornerstone of how India taxes gifts. Essentially, if you receive money or assets without consideration, which is just a fancy legal way of saying you didn't pay for it or provide a service for it, it gets classified as income from other sources. That is, unless it comes from a specified relative.
And here is your danger zone, 50,000 rupees. If you gift money to absolutely anyone who falls outside the strict legal definition of a relative, any amount that crosses this 50,000 rupee threshold in a single financial year is fully taxable based on their personal income bracket. And just to be super clear, this isn't some low, flat tax. It gets added right to their total income. A massive gift could literally push them into a punishing 30% tax bracket.
What's really fascinating here is that the taxman's definition of family doesn't always line up with our cultural definition. Gifts to your spouse, your parents, siblings, and lineal descendants, like your kids or grandparents, are totally exempt, no upper limit whatsoever. But your cousins, your nephews, those close family friends who are basically uncles and aunts to you, the Income Tax Act excludes them. They are not legally relatives.
And that right there brilliantly illustrates a very common trap. Let's say you decide to send that 1 crore to your cousin instead of your parents, maybe because they're handling a local family situation for you. Well, they are in for a massive tax bill. That entire 1 crore becomes their taxable income. The legal relationship status actually has to exist at the exact time of the transfer.
Okay, so let's say you've navigated that tax maze perfectly, and you're sending the money directly to mom and dad. Are we done? Not even close. Even if your gift is 100% tax-free, cross-border transfers still have to follow FEMA, the Foreign Exchange Management Act, along with strict banking regulations. FEMA is basically the master rulebook for any foreign currency entering or leaving India.
Just to give you the full picture, let's briefly look at the outgoing side. If a resident Indian is sending money out to an NRI, say a parent funding a kid studying abroad, the liberalized remittance scheme strictly caps that gift at $250,000 per financial year. You can't just send unlimited funds out of the country, even to your own child. But let's flip it back to our main scenario. For an NRI sending 1 crore into their parents in India, there is absolutely no regulatory ceiling under FEMA. You want to send 1 crore, 5 crores, 10 crores. Go for it. As long as the funds are from legitimate overseas sources and you use proper regulated banking channels like an NRI or NRO account, you are good to go. FEMA is actually highly permissive for inbound money meant to support your family. All right, now we need to pivot to a really major complication. Let's say your parents have that 1 crore sitting safely in their Indian bank account. It was tax-free, it's totally FEMA compliant. But what if they decide to withdraw it and buy a house in cash? Before sending large amounts for a house purchase, medical treatment, or anything like that, you have to be intensely aware of the severe cash transaction limits in real estate.
2 lakh rupees. That's the magic number. Under Section 269 ST, a person cannot legally receive 2 lakh rupees or more in cash in a single day, for a single transaction, or for a single event. Meaning, your parents absolutely cannot legally buy a property by handing over a suitcase full of the cash you just gifted them. The days of large, undocumented cash property deals, they're completely over.
And guys, it actually gets even tighter under Section 269 SS.
You cannot even accept more than 20,000 rupees in cash as an advance or a loan for buying or selling property. If a builder asks your parents for a 50,000 rupee cash advance just to secure a flat booking, doing that directly violates this section. Everything absolutely must be done through banking channels.
The contrast here is literally night and day. Use legal digital channels like NEFT, RTGS, or checks, and you are completely safe. But if you try to circumvent the digital banking system and deal in cash above those legal limits, you're looking at a devastating 100% penalty on the cash amount received. If your parents take 30 lakh in cash for a canceled property deal, they face a 30 lakh penalty. They would lose the whole shebang.
So, the big takeaway is that the system is tracking everything. Which brings us to your ultimate safeguard, Section 68 of the Income Tax Act. Even if your 1 crore gift is totally tax-free under the relative exemption, the taxman can still use Section 68 to demand proof. They can knock on your parents' door and ask, where did this crore come from? Can you prove the identity of your child, their financial capacity to actually earn this much money abroad, and the genuineness of this transfer?
To survive that kind of intense scrutiny without breaking a sweat, you need to follow an exact blueprint. Step 1. Execute a formal, written gift deed. This proves the money was given out of love and affection, not as some hidden business payment. Step 2. Demand an EFIRS. That's an electronic foreign inward remittance statement from the Indian bank is ironclad proof the money came legally from overseas. And Step 3. Keep your overseas bank statements handy to prove you actually had the capacity to give this gift.
We've just seen how a simple yes to sending money home actually opens up a complex web of tax exemptions, FEMA limits, and severe real estate penalties. Before you send large amounts for a house purchase, medical treatment, or family support, you absolutely must make sure you understand both the tax and regulatory requirements. So think about it. Are you absolutely sure your next big transfer is fully compliant? Gift wisely and always plan before you transfer.